A bank lends a company 2 million euros. Every check said the loan was safe. The score was low risk, the file was clean, it was approved in a single afternoon. 18 months later, the company collapses, and the bank never sees most of that money again. Nobody broke a rule, nobody lied. The system worked exactly as it was built to. So how do you catch a loss when nothing went wrong? By the end of this, you will know what credit risk really is, what an auditor actually tests when a loan goes bad, and the one question that takes the whole thing apart. So, first principles. A bank makes money by lending it out and charging interest. Credit risk is the plain and ancient danger sitting underneath all of that. The borrower does not pay you back. For most banks, loans are the largest and most obvious place this risk lives. And it is not a small footnote. The people who supervise banks say it out loud. The main cause of serious banking trouble is, again and again, sloppy lending. So the root question of this whole video is simple. When a loan goes bad, whose job was it to see it coming? Now, a bank does not judge each loan on gut feel. It runs a machine. Every borrower gets a rating, a score for how likely they are to default. From that score, the bank estimates the expected loss, and it puts money aside for it in advance, called a provision. So a bank already assumes a slice of its loans will go bad, and it prices that in from day one. That is the strange part. One loan defaulting is not a shock. It is a cost the bank planned for. Our 2 million euro loan got a good score, so the machine waved it through. When that loan blows up, a lot of people look at it. But one team looks differently. And that team is internal audit, the bank's own independent inspectors, sitting in the third line. Here is what they do not do. They do not redecide the loan. They are not going to reread the file and argue the borrower looked fine. That is not their job. Their job is to ask whether the machine that approved it actually works. One bad loan is a data point. A broken machine is a finding. Here is what a smart, busy banker assumes. The loan went bad, so someone made a bad call. Find the loan officer who signed it and have a word. Reasonable. Also, usually wrong. Remember, the bank expected a share of its loans to fail and already priced it in. A single default is weather. It tells you almost nothing on its own. What an auditor is chasing is not the one loss. It is whether the whole system that is supposed to catch bad loans has quietly stopped working. Weather is normal. A broken barometer is the problem. So the auditor pulls the thread and finds something familiar. Why did the committee approve it? Because the score said low risk. Where did the score come from? A model. Who says the model is any good? A separate team that validates it, the second line. And who relies on those validators? Everyone above them. Nobody in that chain reran the work below. Each link trusted the check underneath it. This is not laziness. A bank cannot re-verify everything from scratch, so it leans. The whole system runs on reliance, one check resting on another, all the way down. And here is the twist. Internal audit is allowed to lean as well. It cannot personally retest every model in the bank, so its own rulebook lets it rely on the work of others. The 2024 Global Internal Audit Standards even have a rule for it, Standard 9.5, Coordination and Reliance. But it comes with a hard condition. You may lean on someone else's check only after you have proven they are competent and truly independent, and that they actually did the work. Reliance is never inherited. It has to be earned, every time. So how does an auditor take credit risk apart? 3 hard rules. 1. Test the process, not the single loan. Is the policy well designed, and does it really run in practice? 2. Never inherit a check. If you are leaning on the validators, first prove the validators earned it. 3. Follow the model. A rating model is trained on the past, and the world moves. The real question is whether anyone checked that it still fits reality, or whether it quietly drifted while everyone kept trusting the number. Now rewind our 2 million euro loan. The auditor does not ask, was this a bad borrower? They ask, did anyone actually check the score? And there is the gap. The model had not been revalidated since the borrower's whole industry shifted. It was rating a new world with old assumptions. The committee leaned on the number. The number leaned on a model nobody had rechecked. Every rule in the book existed. The reliance was just blind. That is the finding, and it was never about one company. One last thing, because it is changing this job right now. That auditor tested a sample, a handful of loans, and trusted the rest. AI removes that limit. It can score the entire loan book at once and flag every rating that has drifted away from reality, the full population instead of a slice. But two things do not change. Credit scoring AI is treated as high risk under the EU AI Act, so it is watched closely. And a human still signs the opinion. The machine finds, a person is still accountable. So, what is credit risk? The oldest bet in banking, that the borrower pays you back, wrapped in a machine of scores, models, and provisions that everyone leans on. And that is the whole lesson. In credit risk, every check rests on another check. The auditor is the one who walks the chain and makes sure that somewhere someone actually looked. If you are learning this world, steal the question. Who checked this, and did they really? If breakdowns like this are useful to you, the free Reg AI Brief newsletter is where the next one lands. I will see you there.